Hi, my name is Roshan, and now I'm going to walk you through some common investing mistakes. So, mistake number one is investing without having a proper time horizon. So, what is a time horizon? I'd like to think of time horizon as the amount of time you'd like to stay invested in a particular asset before you'd like to reap the benefits out of your investment. So, why is it important in building your portfolio? So, a professional would use your time horizon to draft a proper asset allocation plan. And your time horizon would be the bedrock on which your asset allocation is built. So this depends on various factors, such as your financial goals, whether they be short term, like saving up for vacation in the next 6 months to a year, or some expense that's coming up in the next like 1.5 years, or long term, like buying a house in the next decade, saving up for your children's college education, or even saving up for your own retirement. So your time horizon would fundamentally affect the instrument that you're recommended to invest in. For example, if you have a short-term goal, you would need the liquidity, and also your primary objective would be capital preservation. So you might be suggested to invest in short-term debt instruments. Whereas for longer-term goals, you may want to invest in equity because it offers a higher rate of return in a longer period of time. And also the short-term volatility in equity can be offset by the benefits you'd reap in the long term. Our second mistake would be having an unbalanced asset allocation. As you all may know, we have various types of assets, such as stocks, bonds, real estate, commodities, and even cash. Allocating your capital into these assets in a proportion is known as asset allocation. So a professional would draft a customized asset allocation plan for you based on your risk profile and your future financial goals. So the risk of having an unbalanced asset allocation is twofold. If your allocation is biased towards more conservative assets, you run the risk of not maximizing your wealth creation potential in the long term. And if your allocation is biased towards more aggressive assets, you run the risk of having unnecessary volatility in your portfolio in the short term, and if you have short-term goals, you run the risk of not fulfilling them. So as your asset allocation is based on your financial goals and your risk profile, it's pertinent that you understand what your risk profile is. Which brings us to our third mistake, which is investing without understanding your risk profile. So a risk profile is an evaluation of your willingness, your ability, and your capacity to take financial risk. This is based on various factors, such as your age, the amount of dependence you have, and the amount of wealth that you've already created. So all of these factors are taken into account to determine what financial product in what amount would be right for you. Risk profiling helps you understand if you seek risk or if you're averse to risk. A risk seeker is a person who may be willing to accept significant amounts of volatility in his portfolio for his long-term wealth creation. A risk-averse person may also have long-term wealth creation goals in mind, but would not like to see that much volatility in his portfolio. Investing based on your risk profile and understanding your risk profile is very important to you in your financial journey. And the most important thing in your financial journey is that you stay invested. And the chances of this happening are much higher if you invest based on your risk profile. So we now live in an age of social media, where we have an abundance of free information. And most of this is a blessing. But like everything, too much of the media and social media can quickly become a double-edged sword. Which brings us on to our fourth mistake, which is listening to the noise. No doubt some of the information that we acquire from social media proves to be useful. But an equal amount, and some might dare say even a higher amount, is actually misinformation. So when we see or hear about something negative, our brain automatically tends to assume the worst case scenario before it can rationalize the truth. So connecting to this would be herd mentality. Fear and euphoria lead to mass selling and mass buying. Panic buying and panic selling are not based on fundamentals, but instead based on momentum. And momentum investing is not a sound investment strategy for long-term wealth creation. Let me explain how this happens. So when the herd drives the price of an asset up, the performance expectations from that asset will increase dramatically. And when the underlying asset cannot deliver on these unrealistic performance expectations, the herd would begin to sell in a panic. So this would be counterproductive, especially if you invest at the end of the bandwagon where the prices are really high. So when investing, I implore you to have a certain independence of thought. Thank you.
So you think that these are the only mistakes that investors make? Let's look at some more. So when it comes to investing, the first thing that comes to an investor's mind are returns, be it a small investment or a large one. As investors, we tend to base our market expectations on what the market is currently performing, irrespective of whether it's good or bad. So as a result, we fall into this trap of overbuying currently outperforming asset classes and underowning currently underperforming asset classes. But as investors, we are more inclined towards products that have had high double-digit performance. So the reason of why I'm stressing on had is because it is subject to the past. So most of the time what happens is that we go online, we search for content and then we look at the number being posted. But we fail to understand that the number being posted is subject to its past and not what it will perform in the future. So just to give you a broad example, I have taken the chart for Nifty Midcap 100, Small Cap 100 and the Nifty 50 all the way from 2014 to 2019. So very first, we notice that since 2013, the Midcap 100 and the Small Cap 100 index have outperformed the Nifty 50 benchmark by 15%. From 2014 to 2017, the Midcap 100 and the Small Cap 100 index have generated about 47% and 57% return. But the Nifty 50 has generated about 27% return. So that's in the past. Let's look at the current scenario. So the current scenario is that the mid-cap and the small cap index have underperformed the Nifty 50 benchmark by 8% and 4% respectively. Let's look at the next one. So we all know that investing is a continuous process, but as investors, we don't tend to follow through. We buy when the market is booming and we sell when the market is in trouble. So what do you think happens between that buying and selling? Wealth is lost due to poor timing and bad decision making. For a portfolio to consistently perform, you need a portfolio that is active. So the idea of continuity here is to ensure that the corpus being invested increases by a steady amount so that you don't have to worry about timing the market, you'll just be investing more overall. This way, you'll not be chasing winners just because they have won, but you'll be investing the smarter way. So just to give you a broad example, this is the equity MF inflow from March 2018 to March 2019. Again, very first, what do you notice? So in March 2018, equity MF inflow was about 6,600 crores when the Nifty was below 10,500. Look at the next consecutive month. In April 2018, equity inflows doubled to 12,549 crores when the Nifty was about 10,700. Let's move on to the next one. We must not allow other people's limited perception to define us. Now, this is one of the most common mistake that investors make, be it the most successful investors. Now, why does this mistake occur? This mistake occurs because fact and opinion are uttered under the same breath. So, to break it down, fact is backed by evidence, but opinion is based on somebody's feelings and what they think about. And as investors, we base our decisions on opinions rather than facts. So, as investors, we need to know and understand the thin line of difference between what a fact is and what an opinion is in order to know the reliability and the utility of that information. So, just to give you another broad example, if you've been following the news, you are aware of the entire interest rate cut debate. Journalists, economists, various other market participants have all been vocal about what they think is right for the economy. Such opinions tend to frame a reality which might not actually be true. Let's move on to the next one. Now, Warren Buffett. Now that I have your attention, what the human being is best at doing is interpreting all new information so that his prior conclusion stays intact. Now, I'm going to break this down because of the intensity it has in the investing community. So, let me start with a conclusion. Large cap stocks are overvalued. What happens next? So, we start to cherry pick information and look at that information which conforms to our beliefs and our ideas. So, basically, what we're trying to do is come to a conclusion beforehand, then start to look for information that conforms to that conclusion, giving us a very misjudged and a very biased opinion and a biased view. But as investors, we fail to realize that we must not be doing this. So the take home lesson here is that when you set your hypothesis, look for instances that prove you wrong. This will give you a method to look at things in a very unbiased manner. So, to give you a broad example, this election season has been entertaining so much. But very basic, what happens during an election season? We start to look at positive information for our favorable candidate and we start looking at negative information for the candidate whom we don't like. Your fear could be coming from an exaggerated perception of risk. Risk is a word disliked by everybody in our community, yet plays such a significant role in investing. We live in a delusional world where we expect a reward for not taking any risk. Risk is in everything we do. When we invest in any product, we are undertaking a certain amount of risk which you may not be aware of at that point of time. Such risk cannot be avoided. So rather than shying away from such risk, you must understand the kind of risk you are exposed to and how well it fits within your capacity and tolerance. So to make you understand the concept of risk, I have a small video to show you. So as you can see, risk is not defined by the situation but by your fear. The child is terrified of drowning until he realizes the risk that he is exposed to. Always remember, risk will never change, only your perception can. Thank you.